Yeah, Sam, I'll take over. Thank you. Thank you guys for joining in on a Saturday evening. I know it's a good weekend ahead. Everything is back to normal now. All the holidays are over. Schools are starting from tomorrow on Monday. So let's actually start. So we are seeing, the European Central Bank raising interest rates. We're seeing what the US Fed is doing with interest rates. So Sam, for the RBI, what is this? Is this a pause or is this a pivot? What is this?
So I think when we are coming to what we wanted to discuss today in the webinar, right? We set up this time because we felt there are a lot of questions that are coming about, oh, what is the RBI going to do? What is the Fed going to do? Is there going to be a recession? How should I approach investments in this context, right? And because you have all of these questions, and this is causing investors to actually hesitate in taking the next step. There's a lot of reluctance uh, to make any decision today because they're worried that, okay, maybe there's an opportunity that's there in the future which might be better for me. So that delaying of the start is the context in which we've organized this webinar. And given that this month has been really big in terms of monetary policy, we've had, like Harshal mentioned, the ECB, we've had the Fed, we've had even the RBI come out, right, and announce some new policy measures. So with respect to the RBI, this is something we've been hearing for the past couple of policies, because even in the April event, the first thing that the governor actually said is, this is a pause, this is not a pivot. Because consistently for the last year or so, central banks have been raising rates. And RBI decided ahead of the Fed, actually, that they were going to pause and not increase interest rates in April. So there was, obviously, the governor understood that there was a possibility that people were interpreting this as a pivot, meaning that, okay, now for the last for the last year or so, we've been raising interest rates. Maybe from now we're going to be cutting interest rates, because everybody likes to think about the rate cut because that means easy money. It means better things in terms of economic performance, and even for the stock market, lower rates are a good thing. But if we start looking at what the June 2023 policy actually told us, I think we would notice that there are a few things that can point us to the direction of whether this is going to be a pause or a pivot. So if we look at inflation per se, these numbers have been coming down gradually for a while now. And in fact, our May print was the lowest in 2 years almost, right? And with respect to GDP, our GDP numbers were much better than expected, meaning the projection was 7% for the whole of last year, and we ended up at 7.2%. And the last quarter was actually a really great quarter. So on the growth side also, there's been a lot of positivity. And the narrative that we're continuously hearing is about the India story and how India is positioned to do really well in the future, and how there are a lot of structural changes that are going to help us in terms of long-term trend growth. But let's look at what the RBI said, which is basically their stance. So what is it that they were thinking about? They have clearly said that our monetary policy stance is withdrawal of accommodation. So what does that mean? That actually means that you're looking at tighter policies. The RBI knows that, okay, inflation has come down and maybe the worst of it is behind us, but that doesn't mean that it's not a problem, right? We are below 6%, but we're not at our long-term rate of 4%. We're slightly above 4% now. Your core inflation is still quite sticky, right? So that hasn't really come down meaningfully. And if core inflation is sticky, then eventually that's going to translate into general, your overall inflation number as well. The next thing that could be weighing on the RBI is about monsoons, because so far food prices have actually been cooling off. But if you have a tough monsoon year and if that affects food productivity, then of course you're going to have inflation in the future. So it doesn't make sense to, become accommodative today and then after a couple of months come back to a more tighter stance, because essentially that can cause more harm to the economy than following a smoother path. And where we are today, because growth is supporting us, there's no need to actually cut the interest rate. as long as growth is strong, we could actually be heading into an era where you have higher interest rates and higher growth, right? There is no need to cut back on the interest rate, which is why your repo rate has been unchanged at 6.5%. Now, the interesting thing here is that while the RBI is saying that their interest rate policy is withdrawal of accommodation, that is, they're going to be tighter on the interest rate policy, they're actually uh, a little bit more generous with the liquidity policy. So, yes, we're still in system surplus. We're closer to neutral than we were in 2020, 2021, because those were our COVID years. And 2022 also, we were at a higher surplus liquidity. And we've come closer to the neutral level. We're not yet there. But the RBI has vocally also said that if we do think that there is a need to support the economy, we can be a little bit more accommodative on the liquidity side. So you're not going to have lower cost of borrowing, but you are going to have more money in the system if the necessity arises. So I think the way the RBI is approaching it is that yes, it's a pause, it's not a pivot. The way that it's going to be is data driven, which every central bank has actually vocally said that they want to follow the data. They want to make decisions based on data. And it seems that nobody really has a lot of visibility into what the future is going to look like.
See, now that you told me that there's no visibility, and I keep hearing stuff and I keep reading a lot of stuff of whether we're actually copying the Fed. So are we actually following the Fed?
I think in terms of following the Fed, right, there is some requirement for divergence to occur because we need to acknowledge that until now, maybe there's been globally all countries and economic systems have been saddled with the same kind of problems, right? COVID hit the whole world at the same level. Uh, and you did have this sudden shift towards extremely loose monetary policy for a couple of years. And then inflation hit everyone at the same time. And following that, you've had a divergence because some countries were able to roll back all of their accommodative policies that they had during the COVID years. Some countries were not able to handle that. And if you see, the US has some issues on the banking side also that they need to grapple with. Whereas if you look at, say, the European Union, there the bigger concern is actually inflation. They've still not been able to bring that down, right? So even though they, so I think that, and you can see this month there's been a divergence. The Fed did not raise rates, but the ECB did. RBI did not raise rates, but RBI stopped raising rates before. So I don't really think we're in that situation where we're really following the Fed, right? And if we look at what came out of this, in terms of like the Federal Reserve policy this month, you'll notice that all this while when Jerome Powell, like Chair Jerome Powell was talking about inflation, it was like we will do anything to bring inflation back to 2%. So it was always inflation first and everything else is going to take a backseat. But this time, for the first time, you notice that the Fed is actually worried about other things. Like they've talked about in previous policies, how the second half of the year there might be a mild recession, right? And if you look at the March uh, minutes and the March sort of summary of economic projections, pretty much every member expected a recession this year. But now that we're in June, there's not a single member who's expecting that, right? So the expectations are constantly changing. Uh, and by and large, I think the indicators in terms of market strength, in terms of GDP growth, everything on the US side also is pretty strong. But what is worrying is the banking sector because you've had three banks fail, you've had another bank being acquired by someone else. So there is, and these are all unexpected sort of things. Earlier last year, and this has been erased from public memory, but like in the UK, you had a lot of insurance companies go through some trouble because of MTM on their long-term bond portfolio, right? So clearly, like in 2023, this policy itself is going to be data driven. Nobody wants to guess where we're going to be 4 months from now, 6 months from now. They want to take data and then say that, okay, this is my immediate action point, and that's how I'm going to address it through monetary policy. And if we have to talk about a Fed pivot, so to speak, this time, there was some communication about how this pivot would happen, right? Meaning they want to maintain real interest rates at a particular level. Only when you have positive real interest rates, which I think the Fed is kind of close to reaching that target now. Uh, so when you have sustainably positive real interest rates, then only you can look at a Fed cut. But in terms of probability, because GDP is below trend, as long as your real interest rate is positive, there is a possibility that they could cut interest rates. But when that will happen, even the Fed is not sure. And in their expectation, it's not going to happen in 2023.
So where does the Fed actually see interest rates to go?
So there is an interesting piece of data point, which is the dot plot. Right now, a lot of people say that this is not a very relevant thing to look at because it changes quite a bit and it's never had any real predictive power, right? But when we look at it, what we do get is a sense of how committee members feel about interest rates, how they feel about what kind of decisions they're going to take in the future and what they're really worried about. And when and of course, the fact of the matter is nobody can predict anything, right? So just because it's the Federal Reserve or just because it's some other well-known economist doesn't mean that they're going to get it right. But this gives you some divergence of views. So if we look at 2023, each of these dots represent one member's vote. So there are totally 18 committee members. And if we look at 2023, pretty much our current interest rate is between 5 and 5.25%, which is like the bottom of this 5% line. Uh, so pretty much everyone expects rates to stay at this level or go slightly above. So the year-end projection is actually 5.6%. But if we move 1 year down the line, uh, maybe about 1/3 of the members are expecting rates to be at current levels or higher, but the rest are expecting rates to reduce. And this is partly because some of them are expecting real rates to continue to be positive, and that would create room for a rate cut. Some of them are expecting maybe some fears in terms of uh, a slowdown in growth, which would necessitate a rate cut. But pretty much by 2025, nearly all members are expecting rates to fall, right? And there onwards, their long-term policy rate is slightly anchored at around 2 to 2.5%. So you can see that people are expecting things in the long run to get back to normal.
Sam, I'll be honest with you. I have needs. I have to. I need a lot of experiences, and all of that costs money. So should we actually worry about inflation? Because I'm saving a corpus now for my retirement. Should I actually be worried about inflation at all?
I think it really depends on where you live, right? Because if you look at broadly the inflation numbers, right, both India and US, I have come out at the same level in April, which is roughly like 4.5 to 5%. That's the band that we've been in. Now, 5% inflation in India is normal, right? It's not an abnormal amount, but 5% inflation in the US is a really huge thing because you can look at this data prior COVID, right? This chart shows us, so the orange line is the US and the white line is India. So the chart shows us that basically pre-COVID, your inflation was like 2% or below. Yeah. Uh, and post-COVID, for a while, you had less than 2% inflation. And then in 2021, your inflation just skyrocketed almost to 10%. So I think you touched 9%. In the Eurozone, it crossed 10%. And since then, they've been bringing it down. And part of this, so 2021, your inflation expansion was basically because of supply chain issues and logistical issues. And 2022, as we all know, is basically because of the commodity issues related to the Ukraine war that happened, right? So uh, but we've done much better in sort of bringing inflation into our band. So our band is actually 4% plus or minus 2%. So 5% inflation is not out of my band or out of my comfort zone. So as of now, I don't need to worry about inflation. But like I did mention, there are potential risks if we don't have a good monsoon. You could have some spillover effects from that. With respect to the US, sorry, excuse me, I think there also things have shown a downward trend, but whenever we've had inflation reach these higher levels in advanced economies, right, the return to normal has never been a linear 1 or 2 year story. You have had many ups and downs, and it usually takes much longer, closer to 5 years on average, to bring inflation back to normal. And I think this is something that the Fed is cognizant of, which is why a lot of their policies around this data driven idea that, okay, from meeting to meeting, I'm going to review what data comes in, and then I'm going to make an informed decision to respond to that data.
Okay, so what is the sort of direction I need to take now for all my financial decisions?
So there are different ways in which interest rates affect your financial decisions, and this is like a quick framework that we could look at in terms of interest rate mechanics, right? When interest rates are low, it's cheaper to borrow. So you typically see people deciding to go and take on home loans, buy new things on credit, because it's cheaper to do that. And because interest rates are low, the other thing is your safer investments, the returns that you get on them reduces. So your savings in terms of what your bank is offering you, what you get on your fixed deposits, maybe even on certain government schemes like your PPF or your post office savings schemes, all of those returns actually drop. And when those returns drop, you start thinking about taking more risk because you're used to earning a particular return figure, right? So that's when you start behaving in a way that would encourage risk taking. Whether that's right or wrong depends on where you are in your life, what is appropriate for you, and the kind of products that you're working with at that point. But there's a nudge, like from the macroeconomic level, to encourage you to take more risk. So, how you take that risk really matters. When you're at neutral interest rates, you're not really worried about inflation because your ability to purchase or your purchasing power is, you might even have uh, lower inflation. You may, and when rates are neutral, you can still use credit, right? So, but it's not going to be broad based, like across the board, any kind of credit is going to be cheap. That's not how it is. So, here you need to be a lot more careful about how much leverage or how much borrowing you take on. Whether you're an individual, whether you're a corporate, whatever it is, this is where you need to be a little bit more calibrated in managing your leverage. And because rates are neutral, inflation is neutral, your asset growth is going to be sustainable and there'll be fair risk reward across the board. As you venture into higher interest rates, what tends to happen is that it becomes almost prohibitively expensive to borrow, right? So I think your home loan rates are like 9 to 11%. That's not something that everyone would find uh, easy to manage, especially if you borrowed, say, like a floating rate home loan a couple of years ago. Now your EMIs have expanded so much, or your loan tenors have expanded so much that you would want to cut back on borrowing. And because interest rates are high, now similar to what happens when interest rates are low, your safer investments start to offer better returns. So safer investments include fixed deposits, bonds, government savings schemes. All of these are giving you really attractive returns today for barely any risk. And your quality assets will start to perform in this scenario because the economy is generally, when interest rates are high, is going through like a testing phase.
So do I actually need to take a longer duration sort of a call on debt now?
So this is where it gets interesting. And now I think previously in every cycle, investors have learned that, okay, if I'm at the peak interest rate, right, let me buy the longest duration bonds and then I'll get my mark to market gain as the rate cuts start happening. And this cycle you could have played in 2018, 19, and when you had your rate cuts in 2020, 21, that would have worked out really well. But today I don't think you're really going to get that return. And why are we saying that? Your yield curve today is flat. So my 3-month government bond is giving me a 6.8% return. Okay. And my 20-year government bond is giving me a 7.1 return. So that's barely, I don't know, 0.25% difference. Yeah. And so that tells me that I'm really not earning anything for taking on duration risk. And what do I mean by duration risk? So let's say we're wrong. And today the RBI has still said that they could increase interest rates, right? So let's say they do another 0.25% increase. Then my long duration bond gets hit pretty badly. And I would actually lose a lot of money on that. Whereas my short term doesn't really change too much. Like it'll reset. Like if it's a 3-month or 1-year paper, it'll reset within that time frame. So the risk of owning something that's much long term is higher than the risk of owning something short term. And I'm pretty much making the same kind of return. So, and you're not going to really get much of a mark to market gain, because where is this going to go, right? If my yield curve has to go to a normal shape, which is that my short, that it slopes upward like that. If this is the maximum rate for the long term bond, then my medium and short term rates have to fall. So I am going to make my returns only in this part of the curve. Otherwise, you're saying that everything is going to fall, which seems a little bit uh, difficult to believe, right? There has to be some reason for all rates to fall at, meaning your short term falls steeply, your medium term falls a little bit, and your long term falls a little bit, or doesn't fall at all. Yeah.
See, so today equity markets are at an all-time high. It's not only here, we get to hear a lot of stuff even in the US, where some sectors, some names are doing really, really well. And you've been talking about how the second half is more of a mild recession, and so just start dwelling about what about a recession now are we trying to look at in the second half, or what is being projected, or what is being expected.
So I think people have been talking about a recession for quite some time, right? Like even from last year, there was a lot of panic when you looked at the yield curve, and then people would say, "Oh, it's an inverted yield curve. This is like a predictor of a recession." But it hasn't happened yet, right? Uh, and to be truthful, I don't know if it's going to happen or not. And neither does the Fed, nor does the RBI, nor does the ECB. Nobody seems to know whether or not there's going to be a recession at all. Uh, because, like I mentioned, in your so the Fed releases the summary of economic projections every alternate policy meet, right? So the last one was in March, and then we've had one in June. So the March summary of economic projections actually showed that all committee members thought that there would be a recession this year. And within 2 months, you've gone from everybody to nobody expecting a recession. Why? Because your indicators are not pointing that way, right? You've had, so when the first bank fell in the US, people were expecting a contagion. Then you had a second bank, and then you had a third bank. And then by the time it was First Republic, there was already some kind of solution on how you would be handling banking crisis. Now, as far as we know, there isn't any other pressure that's really building up in that space. But there could be, right? Because these things take time to play out. It's not that month on month you're going to have things happen. I think in other news, the Treasury Secretary Janet Yellen was warned that there's a possibility that China may actually remove all of its Treasury bond investments. Um, so to prepare for a situation like that. But there are always other institutions that are going to step up, because Janet Yellen did come forward and talk about how IMF support would be there. And given that the US is the reserve currency today, like, yes, there's a de-dollarization trend, but again, changes in currencies don't happen overnight. Like, you can't overthrow somebody overnight in terms of your currency order. That takes time to play out, and that time is not in a matter of months, it's probably in terms of years. So we're in the beginning of certain shifts. With respect to a recession, Globally, of course, if there is a global recession, there's no way that India is going to be insulated from that. Um, Europe does look to be on a much weaker economic wicket than the US. In the US, I think from a market standpoint, maybe the markets are overvalued because they've continuously factored in only the good news without looking at the fact that they are below trend GDP, right? So the Fed clearly said that this year and next year, the GDP growth rates are going to be between 1 and 1.1%. That's low for the US. That's not a high growth. That's not even a healthy growth number. So maybe there's going to be one. Uh, but if you're going to base your financial decisions on whether or not there's going to be a recession, you're going to miss out on a lot of opportunities and a lot of things that you can do today.
So how should I think of investing, when there's so much uncertainty around?
I think, see, the thing is, we like certainty, but it's never really there, right? We're always getting blindsided by things. Like, who would have thought in 2019, like, that there would be a pandemic? Nobody. Like, even when there was, like, it's called COVID-19, right? So we knew in 2019 that there was something, but we didn't worry about it until March or April, right? I think the market started factoring it in only in February of 2020. We didn't know that there would be a supply chain problem. Nobody thought that, this ship would get stuck in the Suez Canal and that would disrupt like world trade for like months on end. So there is always uncertainty. We feel that, okay, maybe this time is more uncertain than before because this has never happened before, but nothing has ever happened before, right? Like until it happens, it hasn't happened. So I think there's a smart way to approach this. And that would essentially mean to look at volatility as an opportunity because that's when you can scale up or you can restructure. So if you have upward volatility, which is basically the last uh, couple of months, like since April, we've had a fairly strong domestic market, right? So if you have investments that you were not able to sell before, this is a good time to sort of review that and restructure and bring in that liquidity because whatever goes up has to come down. We know that there is mean reversion in the markets. That's one of the fundamental principles of how things work. So when it comes down, buy something. Be ready. Don't try to sell at the bottom, right? You don't want to do that. Uh, the next thing is, I think something we can learn from the central banks. Go slow and steady because you can win the race. Don't do anything in a rush. Don't try to push things. Don't try to predict what's going to happen because there are just so many moving parts today that even the most tuned minds are not able to decipher and give you clear signals as to what is going to happen to the global economy, what is going to happen to markets. And maybe it will make sense to us in hindsight, right? A few years down the line, maybe we'll be able to look back and say that, oh, these were the trends that were happening, and maybe that's why things turned out this particular way. But a few years down the line, you cannot make today's investment decisions, right? You will have to have made them in the past. And that means we need to act today and not wait for a solution before we act. And with investing, I think there's always a season to sow and a season to reap. This is the year where we're sowing. We know that we have to put in our savings into the market. We know that there are going to be multiple opportunities across asset classes. So today we are somewhere between neutral and high interest rates because you have attractive savings, you have decent growth, you have no changes in interest rates for a couple of months. So there's a lot of like stability in the way things are uh, at the moment, right? And I think knowing that is a time where we need to prepare ourselves to do more with our investments. And like I said, if the Fed is going data driven, if the RBI is going data driven, and they are going policy to policy, and they're being systematic about the kind of investment decisions that they are making, sorry, monetary policy decisions that they are making, I think we can also be a little bit more systematic with our investing, right? Why are we trying to second guess uh, the best economic minds in the world? We might as well do what we're used to doing and then respond to situations the way they are responding to situations. So if you want to outperform, the simple strategy is that you've got to scale up, right? And you've got to scale up when the chips are down. You've got to scale up when you're doing well. So whatever additional incremental you are getting, whatever uh, investments have performed well and have run their course, you need to restructure those. Unless you scale up, unless you create that liquidity, you're not going to be able to outperform. There's no point in holding on to notional profits forever, and you know that it's not going to go on forever, right? So somewhere you have to apply fresh thinking, somewhere you have to think about the next step, and you will definitely be spoiled for choice in 2023. Uh, Fixed income is looking attractive. Metals selectively have been fairly volatile, so there have been opportunities to buy. Um, and I think equity markets have held on quite strongly despite whatever fears everyone has had. And there have been months where people have not participated in investments, where people have stopped their SIPs. All of this is really not creating wealth at the end of the day. So I think
Thank you.
that's, yeah, sorry.
Sorry. No, I thought, anyways,
No, go ahead.
thank you so much, Sam, for taking us through so much, and I'm sure that there will be a lot of questions that the participants would have. So, if we do have some time, so let's take some questions. We've already had one question, and uh, when we take the assumption of high interest, high growth, how the trade deficit will get addressed since the high interest rate uh, will certainly impact the export side. Please comment.
Okay, so I think the trade deficit until last month was actually really great. Like May data has not been so good, but prior to that, there was like some level of structural changes. You're seeing a lot of good things on the current account side. But if you have, so more than high interest rates and high growth, I think the real risk is if there is a global slowdown, right? Because then we have always been a net importer, and we will continue to be as long as we're reliant on important commodities like oil. And if there is a global slowdown, then the ability to export or the volume of exports that we'll do because demand will slow down will be lower, and that will widen your deficit. So that's the real risk. uh, I think high interest rates create a case in terms of like currency carry trade because people can borrow in their currency at lower rates and then invest in India. Um, High growth is generally a good thing and it tends to balance out. Okay.
So the next question is, are you expecting any crash? So I can take it. So I think the number one thing that you should stop worrying about is and get obsessed about is whether there's going to be a crash or not. Right? Think of today. Think of the scenario that's happening today. If there are changes that are happening, you have to think of now and later. You cannot think of, if this happens, that happens. So, are you expecting any crash? That depends. We do not know what's going to happen. So, if you do start thinking of, what to do in this sort of a scenario now, because this sort of a scenario is where inflation is sticky, interest rates are high. Uh, so, in this sort of a scenario, what is the best uh, uh, direction to take? That is what you should be thinking of. You should not be thinking of what will happen. Is there going to be a crash? Is there not going to be a crash? Otherwise, you'll always fall into this spiral of not being able to make a decision. So that is what I would say. There's a question on, will the Indian currency strengthen in the falling interest rate scenario? Sam, if you want to take this.
Yeah. So with respect to currency, right, I think it's beyond just interest rates. There are many factors. So one is in terms of like economic strength, how is the economy actually doing? That would give us some boost in sort of appreciating or the currency strengthening. But what we have seen as an observation in terms of how the RBI has managed the currency movement, because last year there was a lot, basically pretty much every currency depreciated against the dollar. So what the RBI has done is that they've basically stabilized the currency. And if we look at flow data, that is foreign investments coming into India, that has actually increased quite a bit uh, in this year. Like there's been consistent flows from foreign investors into the Indian market. So the currency hasn't really appreciated that much, nor did it depreciate too much when you had all of this turmoil last year. So I think where we are, there is some level of stability. but there's no guarantee that it's going to be fixed, right? Because fixing a currency creates a lot of other economic problems. But there is some stability, and the RBI is trying to build back reserves. It's bought a lot of gold. So you have certain things that are working in favor.
There's a question on should we?
This has come in, right? So the first thing is that previously, right, that is until March 31st, there was always this thing of, okay, if I buy debt today, then I have to hold it for 3 years. Otherwise, I have to pay short-term capital gains and I lose my indexation benefit. So there was always this pressure for an investor to be invested for 3 years within fixed income, right? And then it's kind of like you're stuck with that particular fund, no matter whether that's the right fund to hold for 2 years down the line or not. Uh, but today, because you don't have that pressure, meaning you have the same strategy, that can give you these tactical opportunities. So you'll have 1 or 2 years where interest rates have been attractive, where returns from fixed income are going to be good, and you can stay in fixed income those years. And then you can move to a different asset class, whatever is attractive at that point. If debt is still offering you a good risk reward trade off, you can continue to be in debt. If the interest rate falls down, then definitely your returns from debt will also reduce. That's a natural response. But returns elsewhere will increase, and you have that flexibility to move from one asset class to another.
So there is a question on should I pause my SIP or let it go? Because most of them are saying lump sums in bad times are better than regular SIP. Is it true?
Harshal, I think this is your favorite question to answer.
I don't think you should ever stop your SIP. You need to save money. And you are telling that you're in your 20s, you should never stop saving money. You should always keep doing your SIP. And instead, instead of pausing, you should look to save more, which means you should look to step up your SIP every year or year and a half, because the idea is not for you to make money, it's for you to save money, right? Uh, yes, lump sums are really good when the market falls down, but we don't know when that's going to happen. So why should you sit at the bench thinking, I'll wait? You should always look to contribute and save money. And the idea is to save more. Over the long period of time in equities, you will obviously make some sort of 9-12% return, because over a long term, our country is growing. So naturally, our country plus that inflation that comes into the picture, naturally you will grow. Right? So you should never stop your SIP. Instead, look to scale it up. Then the
And
next question. Yeah, sorry,
sorry,
Sam, you
I
can
just
add.
wanted to add one thing to Mr. Kishore's question, that if you're actually thinking that, okay, let's say I'm an investor and I have, say, 10,000 rupees to save every month, and I'm doing that. Uh, and then there's a market correction, right? And because I've been doing only SIP for my full savings amount, then I'm not able to participate in that correction. If that's the fear, right, that when the market corrects, I'm already fully invested through SIP, then you can actually split your SIP, do something in debt and do something in equity. When the market corrects, you switch the debt investments into equity. So that works, but don't try to time it, because let's say, I think even in January people were talking about this, even in April people were talking about this, but April till June has been a very strong period in the market, right? So that means 3 months you've been not invested at all, waiting for a correction that hasn't happened.
So the next question is, everybody's talking about Nifty going beyond 90,000, 19,000, and the Fed is talking about inflation coming down. So in India, what's the scenario in the coming days?
So I think our biggest data point that we would actually have to look out for in terms of inflation is the monsoon. And that actually is going to take time for it to fully manifest. So, of course, June is going to be the month when we receive rains. Probably July, we'll be able to take stock and tell whether there's been this thing. But your productivity comes only like few months down the line, right? You'll know if there are food shortages only when you get closer to the harvest time and see what has been the yield. And I feel that is going to take a while for you to know. Uh, which is why participating continuously is the important thing. Because yes, you need to prepare for the worst case, but what if the worst case doesn't happen? But by and large, I think macro wise, we're looking good. Like we have a clean banking sector, lending is going strongly. You have we have not raised interest rates. We have the support of RBI in terms of liquidity and growth. Inflation is basically the one thing that could actually upset the basket, and that's something we need to monitor continuously. There's no point in trying to predict either way. That there's no point in being very laid back and saying that okay, if it's there, we'll worry about it when it comes. But at the same time, there's no point in anticipating or worrying too much about how high that's going to go.
Then there is a question on, is Germany going through recession? If so, will it affect other economies like US and India? Second question to that is, once the Ukraine war ends, what will be the impact and will the market go up?
Okay, so definitely, if any of the major economies are going through a recession, there will be a ripple effect. But the extent of that ripple effect is yet to be determined, right? Uh, I think in the EU, yes, they are all in a much, much tougher situation. So UK, Germany, uh, France, the smaller EU countries in terms of GDP, are also going through some level of difficulty, right? There you have inflation at like 10%. Your interest rate is at 4%. That gap is huge. It's like a yawning gap. And you've had this level of inflation for more than a year now. Over and above that, like you have this last year, you had a lot of focus on the energy crisis and everything. So I think it's not given that US and India will be completely insulated from whatever happens in Germany, but the impact I think would be less than say the US going through a recession, because simply because the US is the has the reserve currency, a lot of global borrowing, and a lot of uh, reserves from central banks are also held in dollars, plus uh, a whole host of other factors. Okay, if the like once the Ukraine war ends, if the Ukraine war ends, we don't really know how that's going to play out, right? What will be the impact? I mean, that totally depends on the outcome of the war, right? Whether the world is happy with that, whether it seems like there's going to be more economic productivity coming out of that, what kind of reaction the world has, like it totally depends on what happens at that point.
Just to add to that, irrespective of the war, we're still at an all-time high. So I think that was in 2022 and now we're in 23. So all the effects have already come in. It's already playing out. It's already played out. So so we don't know when the war will end. But we don't know if it's actually ended also. Next question is, under fixed income, how do you build a debt portfolio for a moderate risk taker? Will target maturity funds work in the current market scenario?
So I think in debt, there are many ways in which you can build a good portfolio. One of them is through SIPs, because that actually gets you into the habit of saving, especially investors who do things like recurring deposits, right? The returns on recurring deposits are so much lower than what debt funds have to offer. That spread is so wide that, and you'll get the same kind of high quality, low risk investments in the mutual fund space. So I think that's one great way. With respect to target maturity, it makes most sense if it's goal aligned. If the maturity of the fund coincides with one of your goals, then in that case, I think it would really work. Uh, but there's a wide range of target maturity funds, right? Like you have 2025, you have 2032. So it's across the board.
Okay, I think we have time for one more question. So the general thinking is when the interest rate cycle reverses, that is goes down, that gold will move up. Is there any past occurrence which disproved this theory? Please comment. Thanks.
I think 2020 would be a good example, right?
So I'll just give you a brief outlook on how gold should be looked at as an investment. See, gold is a currency. It is an alternate to a currency. It is not an alternate to stock, not an alternate to uh, debt, but it is an alternate to currency. Fundamentally speaking, it is an alternate towards a currency. Right? So why against a currency is because when inflation does come into the picture, when interest rates do sort of harden, your currency tends to weaken because macroeconomic conditions of the country starts to weaken. There's some effect that takes place within that country where their fundamentals and their economics sort of get hampered. Now, because of that, goods start becoming expensive, and your purchasing power starts going down because your currency starts weakening. So you need to have an alternate currency in your book. You need to have something that you can use as an alternate where you can that protects you from this sort of a decrease in purchasing power where your purchasing power is just getting eroded. Right? So that's why you should look at gold. However, in the past we have seen since 2017, that is 5-6 years, that the correlation for gold is more towards US treasuries and more bonds than it is to do with currency. But fundamentally, they do start aligning when the currency starts to weaken. So if you've seen over the last 2-3 years, your US currency, that is your dollar index, right, has weakened. Now it has sort of strengthened. So you're seeing gold in the US, that is global gold, somewhere around $1940 or $1950 per ounce. But whenever you see that sort of currency weakening, you do see that gold tends to be a high performer. So we did do a webinar on gold fully. That is for another a product called Sphere. If any of you do want it, do get in touch with your point of contact, or you can reach out to us directly, where we would be able to share it with you. It is there online also, where we do extensively talk about gold and how we look at gold and how we've been valuing gold in terms of currencies and in terms of supply and demand.
I think we still have time to take maybe that question on commodities and metals, but you have covered that as well, right? In this explanation.
Yeah.
All right.
I think the last question is, what is your view on EV industry and sector? It's a good question. Please do reach out to us when we do an equity webinar. If you do have something on fixed income, we'll be very happy to take it.
Just once again, thank you for all the people who've joined us today. This has been a slightly heavy topic, and we did not want to bore you with a lot of macroeconomic data. We did want to encourage you to think about how your investment journey is going to be in a year where monetary policy is more data driven and where meeting to meeting people, your central banks are deciding what is going to happen. And I think it's very natural for us to feel a little bit afraid about, okay, maybe if there is a recession, then I want to wait and then start my investments. Or if inflation is going to be high, maybe I should buy gold as a hedge. So these are normal ways for us to think about investing. But the simpler tricks always work better, right? Being consistent, following a multi-asset approach, being regular with our investments, choosing safety first. These things work across market cycles, across uncertainty. And we just encourage you to keep doing that so that your journey is smooth and you're successful in achieving all the goals that you've set for yourself. So thank you once again. And thanks, Harshil, for all the insightful questions today.
Thank you, Samita. Thank you, everybody, for joining in. Cheers. Have a good weekend ahead.